If you're thinking about turning your home into a short term rental, the mistake most people make happens before the first guest ever checks in. Here's what it actually determines whether this works as a tax strategy or just becomes an expensive rental with no real write off. Hi, I'm Sherry Ayland, CPA and tax advisor, and I help my clients pay little to no tax using my zero tax blueprint. Just like converting to a long term rental, your depreciable basis is the lesser of your adjusted basis or the property's fair market value on the date of conversion. The home appreciated, you use your cost basis. If it lost value, you're capped at the lower number. And that cap matters more here because a strong short term rental depreciation strategy depends on having a real basis to work with, especially if you're pairing this with a cost segregation study. Here's where short term rentals get more complicated than long term ones. Under Section 280AD, a property is treated as a residence, not a rental, for the entire tax year if you use it personally for more than 14 days during a year or more than 10% of the days it's rented at fair value, whichever is greater. This is a full year, all or nothing determination. It doesn't matter that the personal use happened in January through April and the rental use happened afterward. If you cross that threshold at any point in the year, the whole dwelling unit is classified as a residence for all 12 months, not just the months you lived there. This matters most right when you're converting. If you lived in the home for the first 4 months of the year before converting it to a short-term rental, that's roughly 120 days of personal use. Nowhere close to the 14-day line, and almost certainly over 10% of your rental days too. That single fact classifies the entire year as a residence under Section 280 AD, regardless of how the rental portion of the year performs. And once that classification applies, Section 280A C5 caps your deductions at your rental income for the year. No losses, no offset against other income, no matter how strong your average guest stay number looks on the rental side. This is the single biggest difference from the long-term rental conversion. The long-term rental, you're either renting it or you're not. With the short-term rental you're converting midstream into, personal use during the same year can quietly disqualify the tax treatment you were counting on. This is exactly why the timing of your conversion matters so much. The short-term rental loophole from our earlier video requires an average guest stay of 7 days or less, plus material participation of 100 plus hours and no one participating more than you, for the property to avoid passive treatment under Section 469. But none of that matters if you've already tripped the Section 280D residence classification for the year. That test comes first, and it's a full year gate you either pass or fail. A 4-month personal use period before conversion fails that gate outright, which is why the math in Segment 2 matters more than the average stay number itself in that scenario. Where this actually works cleanly is a conversion early in the year with minimal personal use beforehand. Closing on a purchase and converting to a short-term rental within the first couple of weeks, for example, or converting a property you already owned but rarely used personally. One clarification on the average stay side, since it comes up constantly, however many rental days you end up with, personal use days never factor into that calculation at all. Under Regulation 1.469, average period of customer use is total days across all guest rental periods, divided by the number of guest rental periods, built entirely from actual customer stays. If your guests average 5 days per stay across the months you rented it, that's a 5-day average regardless of how many personal use days happened elsewhere in the year. That calculation and the Section 280 AD personal use tests are two separate rules running side by side. Passing one doesn't excuse you from the other. Clear that 280 AD gate, then clear the 7-day average and material participation test. And losses, especially the accelerated depreciation from a cost segregation study, can offset your W-2 or business income the same year. But this only works if you've genuinely stopped using the property as your residence under the 280D text. You can't have it both ways. Heavy personal use and full non-passive loss treatment doesn't coexist. And a couple of quick planning notes. If this timing issue applies to you, since Section 280 AD is measured on a calendar tax year basis, Timing your move out and conversion so your last day of personal use falls before December 31st gives you a fully clean, qualifying rental year starting January 1, rather than fighting the math in a year with months of personal use already on the books. And if you do end up converting mid-year with a year that doesn't qualify, you're not stuck. You can hold off on the cost segregation study until the first full clean year, then file Form 3115 to make a Section 481A accounting method change. This catches up all the accelerated depreciation you could have claimed since the property was placed in service as a single adjustment taken entirely in that year, landing outside the prior year's income cap entirely. So this is obviously a planning issue so that it times up with your high tax years. But converting your home into a short-term rental can unlock real tax benefits, but only if you actually stop using it as your residence under the personal use rules, and only if you're set up to materially participate the way the short-term rental loophole requires. Get the personal use days wrong, and you don't get a rental. You get a residence with an income cap on it. Before you convert, map out your actual personal use days for the year and confirm where you land under Section 280D. That single number decides whether this strategy works at all. Subscribe for more strategies like this every week.